Good day, Junior Tickies. I'm Mrs. Brimacombe. We're going to look now at activity 3. You are provided below with the information to get connected. They sell mobile devices and do repair services as well. The business uses a markup percentage of 65% on cost, and they use the perpetual inventory system. Required: prepare the statement of comprehensive income for the year ended 30 June 2023. Show all workings. So the focus here is only completing the statement of comprehensive income. 3.2, calculate the following financial indicators. So these will be related to the profitability because you only asked to do the statement of comprehensive income. And then we're going to add now by looking at commenting. Then 3.4, stock was found to be missing. So integrating internal control. You are given information A, an extract from the pre-adjustment trial balance. This is before adjustments was done. So they've given you a list of adjustments that should be done. Now I want to show you in this activity, how would you approach this? T accounts is a tool that you can use, but in a test and exam, you won't have time to do first T accounts and then complete what is required. And also think about this now. They've asked you to only complete the statement of comprehensive income. So I only care about my income and my expense for this accounting period. So anything that falls outside of my accounting period must be taken out. Anything short must be added. So it's not necessary to do T accounts and think about but what goes into the balance sheet account section, in the statement of financial position. So when we're doing this, it's important to know step number 1. Know your formats. Know what goes into your statement of comprehensive income. All income and all expenses. It means that we are only going to look at the nominal account section. We start with all the figures that is given to you from the pre-adjustment trial balance, and we write it in brackets. Show your workings. In accounting, if your final answer is correct, you get full marks. But if your final answer is wrong, we allocate marks for workings. And if it's not there, you lose all the marks. So this must be your step number 1. Write the figures from the pre-adjustment trial balance and take it where it's supposed to go. Note number 1 and 2 was not required. So anything that has to do with interest income goes in brackets. Anything that has to do with interest expense is shown in brackets. Your next step is now to do the adjustments. Now when you're doing adjustments, there will be easy adjustments, moderate, and then difficult. So the easy adjustments, not necessary to do a T account. But remember, the T account is a tool which you can use in case you are not sure what you are supposed to be doing. So for the sake of understanding, I'm going to do the T accounts for you. The more you practice them, the better you'll be getting at it. The first adjustment. The bookkeeper forgot to reverse the consumable store statement. Adjustment at the end of the previous year. Now remember that after we've done adjustments and everything, in my new accounting period, in my new financial year, we need to do reversal entries. Refer to your theory booklet on examples as well with regards to reversal entries. This can be asked as a year-end adjustment. Like in this case, the bookkeeper forgot to reverse, and that's why you would find in your extract from your pre-adjustment trial balance, it says consumable stores on hand on the 1st of July 2022. That's the beginning of the accounting period. There was a balance brought down of 3,500. The bookkeeper forgot to reverse that. That means we now need to credit that. It will form part of my expense for this accounting period. So you need to plus 3,500. We took it out at the end of the previous year, because it was left over. So it didn't form part of my expense last year. But now in this accounting period, we had to reverse it because it forms part of my expense for this accounting period. That's why we need to add it. Adjustment number 2. Damaged stock purchased during a clearance sale was returned by the debtor. The merchandise with an original cost price 3,800 was marked down by 50% of the selling price. So this is taking an easy adjustment or transactions which are familiar to you, grade 9. A debtor returned goods which was purchased. And now we've made this more difficult, challenging, by saying to you, the cost was 3,800, but now the selling price was marked down by 50%. This makes it more challenging. So what is the easy marks to get? If a debtor returns goods, it means that the cost will always go into trading stock and cost of sales. The selling price in debtor's control and debtor's allowances. Now, before we go to what is the easy marks for calculations, when you ask only to do the income statement, advice, always do the trading stock T account, because you will need to calculate, was there a surplus or a deficit? And it's compared what we physically count at the end of the year. It's always compared to the new updated balance after you've made the adjustments. So just keep that in mind. So coming back to this adjustment now. The cost price was given, so that's the easy mark to get. Trading stock, if we got it back, our assets will increase. Our expense will decrease, so we need to say minus 3,500. The difficult part. They said to you the business uses a fixed markup percentage of 65% on cost. So I now, to find out the selling price, we first need to work out using the cost, taking 3,800 times 165 divided by 100. That was the selling price. Now the selling price was marked down by 50%, which means that we sold it for 3,335. And yes, that is below the cost. So this is an example. That's why the adjustment said it was a clearance sale. We wanted to get rid of the old stock, so we sold it for less, and we even sold it for less than what it cost us. So now make sure that you take debtor's allowance is an expense which will increase, but it's always closed off to your sales. And that's why we've got minus 3,135. Do not leave that open. Attempt it. Write something there. No, but if goods were returned by a debtor, it means that our sales will decrease. Next adjustment. An amount received from a debtor, 1,800, must be reversed. The amount was originally received from Walter, who settled his debt, 1,950. So if I'm looking at what is happening here, his balance was 1,950, but he paid 1,800. This means discount was allowed, and the difference is 150. Now we need to reverse all of this. And because we're only doing the statement of comprehensive income, I only care about what happens with my expense account. Discount allowed must be reversed, which means we now need to credit that, and if we credit it, we need to minus it from the 4,800. Next adjustment. No entries have been made for the stock that was stolen at the beginning of June 2023. The total cost of the stock stolen was 40,000. The insurance company agreed to pay out 75% of the total cost. Now, first thing, this has nothing to do with the insurance expense account. Stock has been stolen, which means we need to show that trading stock, what was the original cost of the stock that was lost? We're not going to say, well, the insurance company is going to pay out 75%, so the difference, that will go into my trading stock account. No, show the original cost, which was 40,000. Loss due to theft will be debited. What the insurance company is going to pay me out will go to accrued income. The difference is my loss, which is an expense to the business. You could have just said, if they're paying out 75%, 25% is the loss, so 40,000 times 25% means that our loss is 10,000. So look at the two options to get to the same answer. Adjustment number 5, the bank statement was received after the pre-adjustment trial balance was drawn up. Service fees, 250, interest on debit balance. Service fees forms part of your bank charges, so just add it to your bank charges. Interest on debit balance. This is so important that you understand it, and you've learned that right in the beginning when you look at a bank statement. From our perspective, in our bank account, debit, credit. My bank can either be an asset or liability. From the bank's perspective, on the bank statement, if we've received money, we would debit it in our bank account. But on the bank statement, it will be the opposite. If money is received or deposited, our bank statement will show credit. If payments are made, in our books, we would show bank is credited, our assets will decrease or our liabilities will increase. It depends if I've got a favorable or an unfavorable bank balance. On my bank statement, it's the opposite. Debit means payments were made. If you look at your bank statement, a favorable bank balance will always appear on the credit side. Unfavorable debit side. So when it says to you interest on debit balance, that means it is interest expense. It was interest on bank overdraft. So this will be added to your interest expense. Adjustment number 6. The business already received the rent for July and August. The rent increased by 500 from the 1st of June 2023. My accounting period ends 30 June 2023. So this means that we've received the rent for 2 months in advance. But now I can't just take that 106,500 and divide it by 14 to get the monthly rate, because the rent increased by 500 from the 1st of June, which is right at the end of the accounting period. So our step number 1 is we're going to take out the increased amount. This means from the 1st of June, so June, July, and August. For 3 months, it was at plus 500, so that is 1,500. If we take it out of the equation, we would find, but what was the total rent for the entire year without the increase? Be very careful. If you divide it by 12, you're going to get this wrong. Remember that the rent was received for 14 months, which means we need to divide it by 14. That equals 7,500 per month without the increase over 14 months. Now we can simply add the 500 increase to find out, but what was the rent after the increase? And how many months must be taken out? 2. This was income received in advance, 8,000 times 2, that equals 16,000. Because it was received in advance, we need to minus that from our rent income. Insurance includes a premium of 2,700 that was paid on 1 January 2023 until 30 September 2023. So that is 9 months. Don't just assume it's always 12 months. Now, very important. Insurance premium, the insurance includes a premium. That means do not take that 50,000. Included into that 50,000 is a premium that we pay 2,700. That means if it was for 9 months, anything that falls outside of our accounting period must be taken out. This is a prepaid expense. That means 3 months must be taken out, only 6 months must be included. Now, I only care about what must be taken out. That's why we're going to take 2,700 times 3 divided by 9. To take it out, it means insurance must be credited and prepaid expense will be debited. That is a current asset. We only care about what goes into our income statement. To take it out, we need to minus, so minus from the 50,000. Depreciation is calculated as follows. On the vehicles, 20% per annum on cost. Now they say, note that the vehicles are almost fully depreciated. Red lights should go off when you see that. On equipment, 15% per annum on the diminishing balance method. Note, additional equipment was purchased with cash for 28,000 on 1 April 2023. This was not yet recorded. So if we first look at vehicles, calculating depreciation, it says it's almost fully depreciated. That means if you now take 320,000 and you times it by 20%, that's how we would calculate it using the fixed installment method. Because it says on cost. Means that my depreciation will be 64,000. Now, because they said it's almost fully depreciated, red lights should go off. If you calculate the book value by taking the cost in the beginning minus the accumulate, it means that, or not the cost in the beginning, if you just take the cost minus the accumulate, it means that my book value is 64,000. That means 64,000 minus 64,000 is 0. It can never be a 0. It should be 1. It means that the carrying value should then be 1. Cannot be a 0. It cannot be a negative amount. So to find out the depreciation then, if my carrying value or the book value should be 1 at the end, just take 64,000, the book value in the beginning, and minus 1 from that. That means that my depreciation is 63,999. To show your depreciation is debited, accumulate will be credited. So we're just going to write the calculation in bracket. With regards to equipment, now you need to be careful. Always start with the movement. There was an addition of 28,000. It says it has not yet been recorded. It means that that balance from the pre-adjustment is the balance in the beginning. Why is this important? Otherwise, you're going to calculate your depreciation incorrectly. When we calculate depreciation, it's always on the new and on the remaining, the old. You don't need to worry about anything about what we've sold. That will only be happening in grade 11. So when we're calculating on the new, it's from the day we purchased it until the end of the accounting period. On the old, it's that which we had since the beginning of the accounting period. So if you don't get that right by identifying this was not yet recorded, it means that that balance is the balance in the beginning. It means that you're going to calculate the depreciation on the remaining or the old incorrectly. We have to use diminishing, which means the book value. To get the book value, take the cost minus the accumulate and then times it by 15%. On the new, it's from the day we've purchased it. So if we purchase it in April, on the 1st of April, it means April, May, June. It's 3 months. That is why we say 28,000 times 15% times 3 divided by 12. So my total depreciation on equipment is the old plus the new. Show all your calculations in brackets. Then, interest on fixed deposit is due. The fixed deposit has been in existence since the beginning of 2021. Note, the interest on the fixed deposit increased from 12% to 12.5% per annum on the 1st of February 2023. Interest earned is not capitalized. Now that doesn't really matter in completing the statement of comprehensive income. Irrelevant if interest is capitalized or not. I need to show what is my interest income on my fixed deposit for this accounting period. But now, I can't just take the amount from the pre-adjustment trial balance and I can times it by 12% because it increased from the 1st of February to 2.5%. That means that we need to calculate 12% on 180,000 for 7 months and then 180,000 times 12.5% times 5 divided by 12. So here they said interest on fixed deposit is due. So I don't know how much is due. We have to compare this by looking at what have we already received and what is it supposed to be for this accounting period. It's supposed to be 21,975, but we've only received 20,100. Now, interest is not capitalized. This means that if interest is still outstanding, this would have gone to accrued income. The amount which is still outstanding is 1,875. That must be added to the 20,100. The last adjustment, adjustment number 10, stock as per physical stock count on 30 June 2023. That is the end of the accounting period. Be very careful, and I've mentioned this earlier. You cannot compare the trading stock which we physically counted with that from the pre-adjustment trial balance. That is a common mistake. You have to look at all the adjustments and what is the new balance of my trading stock. In adjustment number 2, we had the debtor who returned trading stock, so we need to add 3,800 to the balance from the pre-adjustment trial balance. Then we had trading stock which was stolen and the original cost was 40,000, which means it must be subtracted from that pre-adjustment figure. Our new balance, which is 199,800, must be compared to that which we physically counted, and the difference is the trading stock deficit. Show all your calculations in brackets. If you've done a T account, which will show all the figures you've added and subtracted, that is 100% fine. Trading stock deficit forms part of your operating expenses. Then we've got consumables that was still left over. Reminder, adjustment number 1, there was a reversal entry. At the end of last year, we had consumable stores left over. So that was added to our expense. Whatever is left over at the end of this year must be taken out and taken to consumables on hand, because it doesn't form part of my expense for this accounting period. So we're going to say minus 780. So once we're done completing the adjustments, our next step is just to close the brackets and add. In other words, we start with sales. Your total sales minus your total cost of sales equals your gross profit. If we're looking at our operating income, if there is no change, you just close the brackets and that will be your final figure. Rent income, there was an adjustment, so my total income should be 90,500. Once we are done, you draw a block around it and you add everything in that block to get your total operating income. Gross profit plus operating income equals gross operating income. Now don't be alert if there's a line open that you've made a mistake. Then we've got operating expenses. We need to close all the brackets, and again, if there's no adjustment, then it means you just close that bracket and you fill in that as your final figure. And that's why step number 1 is so important, to take the figures from the pre-adjustment and fill it in where it's supposed to go. We tend to just start with the adjustments and then we forget. But if there were no adjustment to those figures, we forget to include them in our financial statements. So to avoid that, make sure step number 1, figures from the pre-adjustment, easy marks to get. Step number 2, go to the adjustments. Then the third step, calculate the final figures. Once we've done with all the operating expenses, we draw a block around it and we total it. That must be in brackets because gross operating income minus operating expenses equals my operating profit. Plus my total interest income equals profit before interest expense minus my total interest expense equals the net profit for the year. Answering the next question, you need to calculate the following financial indicators. The gross profit on sales. To calculate that, take your gross profit divided by sales times 100. Your answer must be in percentage. Gross profit on cost of sales is your gross profit divided by the cost of sales times 100. That equals 56.7%. My operating expenses divided by sales equals a percentage 36.2%. To calculate the operating profit on sales, we need to take our operating profit divided by sales times 100. That equals 25.4%. My net profit is my net profit divided by sales times 100. That equals 26.7%. So this is actually so easy marks to get if you understand the financial indicators. What is it that I need to divide by what, and where do I get the information? You need to understand also that financial indicators can be given to you, and you will need to find figures by using those financial indicators. So when you're practicing your financial indicators, calculate from the beginning to the end and from the end to the beginning. You will see in our last activity in this chapter, we are going to look at what happens if financial indicators is given to you and you need to find figures. Question 3.3. The owner is not happy with the gross profit on cost of sales. The gross profit on cost of sales for 2022 was 52%. Remember when we started off in this chapter, I said to you, when we're going to look at financial indicators, we're going to compare it to last year's figures to see if there's an improvement or not. So here they provided you last year's figures. And when we look at the gross profit on cost of sales, we also specifically looking at, have we achieved our aimed markup or not? So when this question is asked, you always look at your gross profit and on cost of sales. Do not confuse them. Study. Have we achieved our aimed markup? We compare it to or look at the gross profit on cost of sales. So when we're commenting now, we compare last year with this year, and we're comparing or looking at, have we achieved our aimed markup or not? The question specifically says the owner is not happy. Does the owner have reason to be? Yes. Because the aimed markup, right in the beginning, we said the aimed markup is 65%. So if I compare now with last year with this year, yes, it did increase from 52% to 56.7%, but we still haven't achieved our aimed markup of 65%. We're still falling short. So be careful when you're commenting with this, and make sure that you quote your figures. It might be that you have gotten a different answer here. As long as you quote your figures and you're commenting on that, then you can earn marks. Now it says gives a reason how to improve the gross profit and cost of sales. So how can we get to achieving our aimed markup? Provide less trade discount to customers. Correct calculations of cost of sales, selling price and markup. Correct price on items. Because these are reasons why we have not achieved it. So these are the things that we need to do better so that we can achieve our aimed markup. Question 3.4. Stock was found to be missing. Upon investigation, it was revealed that staff members had stolen stock. Make 2 suggestions on how the business can improve the security of the inventory. So this is based on internal control. Always study your internal control, because you will be given different scenarios that you need to answer in how can we prevent this from happening in the future. What security measures can we put in place? So these are all options that you can write. It says only 2, but I've given you more than 2 options. So you can look at adequate segregation of duties between those responsible for the physical inventory and those responsible for the inventory accounting records. Goods received notes or inventory receipts should therefore be handled and verified by at least 2 different employees. One to enter the document in the accounting records, and another one to secure the goods. So you don't want one person in charge of doing everything. Employees should inspect all goods received to ensure that what they are accurate against the order and not damages. So in other words, if we get the stock, we can't just sign and say put the box down there and just leave it. And then later when we open the box, we notice, but there's stock missing or there's stock damage. You've signed for the stock that it's all there. And you've compared it to the documents as well. This should happen when the stock arrived, not after the fact. Now we notice, but stock is missing. Where has this gone missing? Is it supplier's fault? Did they deliver enough stock? Did the stock what was delivered, was it damaged or not? Or was it actually an employee stealing from the business? There should be physical stock counts, and this should happen periodically. Then, any obsolete or damaged inventory should be written off, and that should be authorized by a senior staff member, employee in the business. So these are all possibilities of suggestions that you can put in place. Thank you very much. I want to leave you with this quote: dreams don't work unless you do. Next, we're going to look at activity 4. Have a wonderful day.